This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hey, this is Aaron Norris. We are releasing 3 radio shows in 1 week. We will be closed for Friday all the way through January 2nd. So we'll be back at January 2nd. But while we're closed, we decided to go ahead and accelerate the radio shows and release the one on taxes a little early because we're getting so many calls and questions. And since we'll be closed, we thought this might be helpful. So on the radio show, it will be released 3 in a row. But we won't be releasing anything new until we get back in the office. So enjoy. Happy holidays, Merry Christmas, and a Happy New Year. Thanks for all your support in our 20th year. And we can't wait to see you on the other side of 2018.
Hi, thank you for joining us. My name is Bruce Norris, and today our special guests are once again Matt MacFarland and Amanda Hahn, owners of Keystone CPA in Orange County. Matt has over 20 years of experience in public accounting as a CPA and tax strategist. He has worked for both the Big Four and regional CPA firms. Amanda has over 18 years of experience as a CPA with special emphasis in real estate, self-directed investing, and individual tax planning. Amanda has extensive Big Four public accounting experience, and you can catch her book on BiggerPockets Tax Strategies for Savvy Real Estate Investors. Matt and Amanda, we welcome you back. It's only been a couple weeks, but we finally sort of have a final document. So I'm so glad to get to speak with you.
Thank you so much for having us, Bruce. It's really a very exciting time for us right now.
Yeah, thanks for having us.
Yeah, since you've had about, 6 hours to digest the 1,000-page document, I'll just say up front, there may be some questions that I'm going to ask, or you feel free to say, you know what, I'm just not sure yet. That's perfectly fair, okay? So some of the things I'm going to cover first is maybe the things that didn't change at all, just to kind of get those out of the way. So are there anything new with taxes for the state of California?
Not that we're hearing and not that we're aware of. So, but California does, obviously work a little behind schedule after the IRS. So it might take them a few months to kind of catch up, I guess, if you will.
Yeah, and that's a good question too, because historically speaking, based on what we see, a lot of times when the IRS comes out with new tax deductions or immediate write-offs, historically California does not follow the federal rule. So it'll be exciting to figure out, or to see whether or not California is actually going to follow federal in terms of some of these tax benefits that we're seeing.
Okay. Anything new with the withholding of Social Security tax or Medicare tax?
No, not that we've seen in terms of payroll-related taxes with respect to the tax reform. One of the interesting things is that the net investment tax, which came out as part of the Obamacare package, actually also remains unchanged as well. And that's the 3.8% additional tax that started a couple of years ago.
Yeah, that was...
Yeah,
Go ahead.
The reason that's interesting is because part of this new tax reform is they've actually, starting in, I think, 2019, they have repealed the mandate that requires everyone to have health insurance, which that 3.8% tax was supposed to be put in place to curb the cost of the health insurance. But if they're so they're not getting rid of that, but they're getting rid of the requirement to have health insurance. So go figure, right?
Yeah, I noticed that. I read that what you said over pretty carefully. Any changes to capital gains rates?
There is no change to capital gains rates per se. So they still have the 0% capital gains rate for people in the lower income brackets. They still have the regular 15% rate, and then they have the 20% rate for people in the kind of the higher income brackets. The only thing that slightly changed on there is the dollar amounts as to when the 15% rate kicks in and when the 20% rate kicks in. But it hasn't changed much from 2017. So essentially, it's pretty much the same.
Okay. I think I'm accurate saying is about 100% of Democrats voted against the bill, and this isn't a political statement. So my first question is, does it lower the tax bill for most Americans?
Yeah, that's interesting. So I think on average, what we're reading is that it's going to it's going to lower the taxes for probably 95% of Americans in 2018, with about 5% of people still seeing actually increase in their taxes.
Yeah, and what's also interesting is that what the research is showing are that the Americans in the 95th percentile, which are the most wealthy, are the group that gets the biggest tax breaks. Or is going to save the most in terms of income taxes. So that, kind of going back to what you mentioned, Bruce, that might be one of the reasons why, you don't see any Democrats voting for it. But the good news, though, is still, I don't know if that's really good news, but that most Americans should expect to see lower taxes overall.
And just to piggyback on that a little bit, I think one of the things that jumped out at me was, and I guess this is kind of the way it is already, but it just still, going into this a while ago, I thought that one of the intentions was tax cuts, obviously, but I thought one of the intentions was to simplify things, and it doesn't look like they've accomplished that, obviously. But one of the takeaways I saw was that, you could have two families with the exact same amount of income, let's pick a number, $200,000, and they could pay, different amount of taxes because it's going to depend on, the makeup of their family, what type of income they're earning, maybe where they live. So again, just because you and your neighbor have, the same amount of taxable income of 150 grand, whatever the number is, don't expect that necessarily you're paying the same amount as they are.
That was interesting because one of the questions I had was, okay, how do you become unfortunate enough to be that 5% that pay more? So what are they single or, or is there makeup of their income just the wrong type, or do we know yet what exactly that is?
Yeah, what's really interesting is, as CPAs, in historically speaking, the group that generally pays the highest tax or the most amount of tax are the W-2 income earners, right? So someone who, the majority of the income is from W-2, don't necessarily have a side business or a business that they own, and don't invest in assets such as real estate. And so that's historically what we've seen. I think as part of the tax reform, that remains unchanged, unfortunately. So Matt and I were just discussing today. It's like, for some of our clients who are just W-2 and maybe starting out to do real estate but don't really have a lot of real estate yet, a lot of these loopholes and changes and benefits don't really help them as much as some other taxpayers who are, business owners or real estate investors. That's the larger group where more of the tax benefits that will be coming in will benefit. So, yeah, I don't know, the 95th percentile, I'm assuming those people are not W-2 workers. But I think there's that middle range of high income W-2 that, might not be seeing as big of a tax savings as, again, a business owner or a real estate investor.
So let's talk about the deductions, first of all. So the current itemized deductions, we get to deduct state and local tax, real estate taxes. Are there any limits for those categories in 2017?
So currently for 2017, you have itemized deductions. You're deducting your state and local income tax, your property taxes on your primary residence, DMV fees, which, they don't add up to a lot, medical expenses if they exceed a certain threshold. You've got your charitable contributions, and there's a bunch of other kind of miscellaneous itemized deductions that people can get if they exceed 2% of somebody's income. So those are the big ticket items.
But there's no limit. So if you pay $100,000 in state and local income taxes, you're going to get to deduct that on the federal income tax.
Generally speaking, there is an overall limit on itemized deductions depending on somebody's income, and there's like 3 ways to go with that calculation. But effectively, yes, there's no per se limit on the actual state taxes or the property taxes per se.
Okay, and in starting for the taxable year next year, what does that change to?
So starting in 2018, the maximum tax deduction, and this is the combination of primary home property taxes and state income taxes, will be capped at $10,000. So if you're someone who, in the state of California, if you pay $20,000 in income taxes and $10,000 in state income and property taxes, of that total 30,000, only 10,000 is tax deductible. So a pretty significant hit to those who live in higher state income taxes like California and New York. So, as we head towards the end of the year, there's not much time left at all. But we are trying to encourage a lot of our clients to, if you find yourself to be someone with anticipation of in 2018 paying more than $10,000 in total state and property taxes, to consider prepaying for those before 12/31/2017. There are instances where you might be someone who is in alternative minimum tax that you're paying AMT, where you might kind of lose out on some of the benefits of prepaying, but it still could make sense to prepay if you have the cash available, because what we know for sure is that only $10,000 will be deductible in the future. And if you prepay this year, there's still that possibility of getting some savings, even if you're phased out under AMT purposes.
Currently, the interest that I owe on my residence and a second home up to what, 1.1 million is deductible?
Right.
And that changed.
Yeah, that's currently. Yeah, so that's the current law. Going forward, it's what a couple things is changing there is the interest is going to be deductible on a loan, an acquisition loan for a new acquisition loan related to your principal and one of the residents, up to a total loan balance of $750. So, meaning if you buy a new house next year for $900,000, you can deduct interest on the first $750. Now, a couple questions we've been getting is, what happens to existing mortgages? So you've got, you bought your house already or 3 years ago, whatever. If your existing mortgage is $900,000, nothing's changing for you. So going forward, you can still deduct interest on up to $900,000. It's really in relation to new loans that you take out starting in 2018.
Wow. That's interesting. Okay. Because if you have a significant mortgage, then you might stay put for that reason. That's interesting.
Yeah, and just to clarify, the $750,000 cap is for new loans, new primary home acquisitions. It does not apply to investment properties. So,
correct. Does it apply to a second home?
Kind of rental? Yeah.
You can add you can do your principal in one other home. And the other thing is that you mentioned the 1.1. Right now, there's on the you can do a deduct interest up to $1 million and then an interest on another $100,000, which is usually like a HELOC for most people. Going forward, that HELOC is not going to be deductible. The interest on the HELOC is not going to be deductible unless you are using it, deducting it somewhere else, like against a rental property. You use the proceeds to buy a rental property or you buy a business or something. But just right now, somebody theoretically could borrow $100,000, go on vacation, and pay interest on that and deduct the interest.
Okay.
That's not going to be allowed forward.
Okay. Donations for charity, as far as being deductible?
Yeah, the only thing that the interesting thing, nothing's really changing there. The only thing that changed was that right now they have a cap on. You can take a deduction up to 50% of your AGI, but going forward, they're going to bump that up to 60%. So that can help. Maybe that's helping the 95 percentile people that are donating 50 or 60%.
Okay.
Yeah.
But I think even though the cap is going up next year, if you're someone, I know you guys donate a lot at the Norris Group, but if you're someone who just kind of donates every year, it could make sense to accelerate the donation to this year, just in looking at the difference in tax rates. If you're someone in 39% this year, you expect to be 32% or 24% next year, then it definitely makes sense to consider accelerating the deductions so you're saving at a much higher rate.
Have you seen an estimate of how many families currently itemize deductions and how that might change with the new rules?
I have not seen an estimate of that in a while. I know when we talked last time, we had looked up, and the latest data we saw was like 2014 or 15, and I unfortunately don't remember that number. But I'm guessing for the people that live in like California and New York, the high state income tax states, they're going to see a drastic decrease in how many of those people are claiming itemized deductions. My guess is, but everyone maybe out, the rest of the country, maybe they've already been taking standard deduction, and they're just going to get an extra standard deduction going forward. But
yeah, I don't know the exact percentage of decrease, but I recall from the Tax Policy Center it was a significant amount or a significant number of people who will be likely moving over to taking standard deduction. So it's interesting. I think, with fewer people itemizing and them taking away the ability to deduct tax preparation fees, then maybe you'll see fewer CPAs actually in business. And then we'll all just turn into real estate investors full time.
Okay. Maybe there's some really good investment group that needs an in-house accountant or something.
Yeah.
I kind of played around with an example, and I don't necessarily have to go through all the numbers. But then there was a category I hadn't really thought about. I said, married couple with 2 kids, and they had the median price home. They owed $400,000 on it. So I did all the math on that. But then I remembered there was in 2017, you have personal exemptions.
Right.
So they had 4 of those times how much? 4150?
Yeah, $4,000 each, so about 16,000 right now.
And in 2018, that's gone completely too, correct?
Right. Yeah.
Okay.
I mean, theoretically, it's supposed to be replaced with the higher standard deductions. But yeah, I mean, one of the things is the doubling of the standard deductions is great for certain people, but for another person in your scenario, a larger household with multiple kids, and maybe they were claiming their elderly parents as dependents, they might be someone who's losing out as a result of the change. So it really differs from person to person, who's going to come out ahead.
Yeah, the deductions went from $40,000 to basically just taking the standard deduction in that example. I don't necessarily have to go over it blow by blow, but I was just curious myself. So
yeah, everything
that they had to deduct basically equaled the standard deduction. And of course, you have lower rates too. So I'm really interested in this category, AMT. I looked at my taxes for 2015 and 2016. Having to pay AMT raised my federal tax 18% in both of those years. So what major category of income or deductions caused AMT to kick in, and how is that going to change after this tax rule changes?
Yeah, it's a good question. I mean, for those of us who live in California, the biggest ticket item that puts people into AMT is the state income tax deduction. So again, AMT is just this parallel tax system that was put in place, 30 years ago to prevent the wealthy from using a bunch of loopholes to avoid paying taxes. So that, the IRS wants everyone to pay a quote unquote minimum level tax. But for AMT purposes, this parallel tax, you don't get to deduct state income taxes. So when somebody has taken a big deduction of state income tax relative to all their other income, especially if they live in California, they're just more likely to be an AMT. So going forward, I think, theoretically, with that big deduction going away, there's going to be, the potential impact of AMT is hopefully going to be less. I mean, that's kind of what we're thinking on the face of it. But there are also a couple other changes to AMT. When you do the calculation, there's a certain amount of the first amount of income is tax-free for AMT. Right now, like a married couple, the exemption amount is about $85,000. So your first $85,000 you don't pay any AMT taxes on. Going forward, that exemption amount is going up to $109,000 for a married couple. So basically, they're giving you some more money free from AMT taxes. And then before that, or right now, I guess, the exemption amount phases out as your income goes higher. And it's not, it phases out pretty quickly, actually. But starting in 2018, married couples got to make $1 million before that $109,000 AMT exemption amount or exclusion amount goes away. So all that being said, I think the AMT tax is going to be less impactful going forward. But, interestingly, they were trying to repeal it altogether, I think, in one of the previous versions that we read, and then that seemed to go away at the end for some reason. So,
okay. Do you consider the tax change bill pro-real estate if for occupant owners? In other words, for the real estate industry, if you're in the business of supplying occupant homes, for homeowners. What do you think the impact of this is?
So for residential real estate, essentially, I think that there are several changes coming out that are beneficial. Not specifically, there are some that are specific to real estate on the housing side, but the majority of the deductions for business expenses also apply to real estate investors, because to some extent the IRS do treat real estate activity as a regular business, just as if you were, owning a Subway franchise. So I think overall, holistically, yes, that there are many changes that should be helpful to real estate investors, reducing overall taxable income.
Okay, this question was directed to home ownership period, though. So I was going to break
for
homeowners. That's right, homeowners. So the industry that provides occupant owners real estate, does this tax bill likely harm that industry or help it? Do you have more reasons to own a home today than you did yesterday? That type of thing.
I think that, it really depends. I think that for a vast majority of Americans, the cap on mortgage interest deduction to $750 should not really have a huge impact. I know, speaking from California, specifically Orange County, it does impact a lot of people, but at large, I don't think that's really something that's going to significantly limit people from owning a home. Other than that, there's not much. Property taxes is part of it, but, I think I've heard you speak before, just outside of taxes. People who are going to own a home are going to own it for reasons outside of tax savings. And I think the impact of limiting the mortgage side of it is not really that significant.
Yeah. And by the way, I wasn't trying to coax a specific answer. I really do want your opinion, okay? So do you consider the tax changes on the bill pro-real estate if you're investors?
Yeah. I think definitely pro-real estate if you're investors. There are things that are now starting next year, are going to benefit investors that never were available before. So yes, definitely a lot of changes that are beneficial to real estate investors going forward.
Okay, we're going to kind of cover that in a category all its own, because I'm very interested in what a pass-through business is and how you maybe get a part of that, okay? One other category, do you consider the tax bill positive or negative for charities? Do you see that being a problem?
Well, it's a good question. I think that, again, the deduction on the actual donor side is, they're not making it harder. They're actually making it allowed to deduct a little bit more. I guess the question would be is the tax cut going to do what they're telling you it's going to do in terms of stimulate the economy? People spend more money. If people spend more money, do they inevitably donate more money?
Okay.
I think if people have more money, they might be more willing to donate. But the question is whether they're going to actually spend that money and not,
Yeah, I think that, I think there's two schools of thought. By doubling the standard deduction, fewer people are going to itemize, and charitable donations are one of those itemized deductions.
Correct.
So I know there are proponents who say, okay, well, you're doubling it now, the charities will be hurt. But what we see also, though, is that a lot of the higher income earners are still going to itemize. And those are the people who are generally able to donate a significant amount of their income or their net worth every year to real estate. And the fact that the tax changes are now increasing it, the cap from 50% to 60%, you might see some, larger donations from those with higher income and higher net worth. So I don't know, on a whole, which one is going to outweigh the other, but I could see it kind of both ways. Maybe lower income people might donate less, and higher income people might be able or willing to donate more.
Okay. Let's talk about corporate income. So the current top tax rate right now is what, 35?
Right. Yeah.
And the new rate is
It's a 21% flat tax. So actually right now, the current law is it starts at 0 and it's a graduated scale. It gets all the way up to 35, and it actually gets there pretty quickly. But going forward, it's actually going to be a total flat tax. So, up 21%. So that's good for the people for the companies that were paying, obviously the 35% rate. That could be bad for the companies that were paying at the 15% rate, but that's effectively what's happening.
Do you consider the tax law change most friendly to business over any other category?
Yeah, I mean, just, since most of the clients are in the real estate side of things, honestly speaking, we don't have many clients who operate in the C corporation in the past, just because there are downsides to holding appreciating assets in the C Corp. The C Corp in the past has double taxation. All of that still remain true. Okay, so they've lowered the corporate rate, but they haven't taken away double taxation. So, for someone, if you're trying to shift your income into a C corporation, the corp's going to pay 21%, and then when you take the money out as dividends, you're going to pay that second layer of taxes, 15+%.
Right.
So across the two, I mean, it's not going to be too much of tax savings. Also, for most of our clients where there's a C Corp involved, it's generally in the past has been to shift income from a flow-through entity tax at 39% down to a 15% rate. And because most of the C Corps are used in our clients' profile, at least for real estate, it's not making $1 million, right? It's making 20, 30, 40,000 of management fees or something like that. So the change in the corporate is actually detrimental to some of these smaller C Corps because now the flat rate all of a sudden is stepped up from 15 to 21%. But yes, it definitely is a huge windfall for large corporations, which, like Matt said in the past, has paid 35% plus dividends on top of that. And to have that go down to 21% is definitely a huge benefit. But, again, purely from a real estate perspective, for investors, for flippers, property management companies, we don't really anticipate a lot of our clients to go out and form C corporations in the near future. Yeah,
I'm kind of thinking overall the general economy too. So one of the rule changes is for new investment purchases for businesses and how they're deducted. So can you talk on that as far as for taxable year 2018? If I have $1 million piece of equipment I'm buying, what's the new rules allowing me to do?
Yeah, great. So there's two new changes. That's the Section 179 expensing, and also there's a 100% bonus depreciation, and Matt can talk about both of those. But I do want to, since we're making the transition, I just want to clarify both of these tax benefits that are coming out are available whether you have a C Corp, S Corp, LLC, sole proprietorship. So any of those are not only available for a specific type of entity.
Okay.
Yeah. So right now, the two big loopholes in terms of accelerating depreciation with respect to equipment or things of that nature are the Section 179 and the bonus depreciation. Those both currently exist. They are just tweaking them somewhat going forward. So the Section 179. Buy a piece of equipment for $500,000, you can deduct it all right away, subject to some income limits. Going forward, they've increased that $500,000 threshold to $1 million. So theoretically, if you buy $1 million equipment and the business has at least $1 million of income, you could deduct that all in the first year. And then they've changed the Section 179 to also expand the definition to include certain improvements made to real property. And when we're talking about real property, we're talking about non-residential real property, so commercial real estate, strip center, office building, stuff of that nature. Now you can include certain improvements there like roof, heating, ventilation, air conditioning, stuff like that.
Yeah, and that's a huge one because in the past, for commercial real estate investments, those types of improvements generally had to be depreciated over multiple years. So this is the first time we're seeing where they're allowing certain improvements on the commercial real estate side to get an immediate expensing up to $1 million.
Okay. How is income from a pass-through business treated in 2017 versus 2018? I'm very interested in this question. What is a pass-through? What's a pass-through business?
Aren't we all?
Okay.
Yeah.
What's a pass-through business?
People have been asking about this for like a week, and it's just like, yeah, we're reading about it. We're still trying to wrap our arms around it because, again, this goes back to them not simplifying things,
Yeah, so I think I think we'll try to put it in the most simplistic form that we can. And, yesterday Matt and I were running some scenarios, just picked a couple clients and did our own scenarios to see how it kind of all falls out. But generally speaking, currently a flow-through entity. The examples of flow-throughs would be partnerships, LLCs, as corporations. And they're called flow-throughs because the entities themselves don't pay any taxes at all. And then the income from the entity flows through to the individual tax return. And then the tax is assessed at the personal level one time. So if I have an LLC that created rental income of $10,000, the LLC pays zero tax, but then Amanda will have $10,000 of taxable income, and I would pay at my personal tax rate. So in the past, it's 0%, 15%, all the way up to 39.6%.
Correct.
And that's what you're probably hearing a lot of time. Flow-through entities tax at the highest rate, and that they're really looking at the highest personal rate. Now, under the new change that's coming up, what they're looking to do is not to change the tax rate or how entities are taxed. Okay, the income is still going to flow through. The entity is still not paying any taxes on its own. But what you can potentially do is to pay zero tax on the first 20% of income that is generated by this flow-through entity or flow-through business. So as an example, if I'm a realtor and I made $100, right, of flow-through income, then assuming I meet all these other requirements, then that means 20% of that $100,000, so $20,000 would be at zero tax rate. And then the remainder, which is 80%, that I would pay on my personal tax return at whatever my personal marginal rate is for that particular year.
So for every strata of tax is a 20% discount. That's what that sounds like. Is that correct?
That's on the face of it, yes. Now, there are some limits that they, of course, put in place to, maybe curb the benefit or make sure people aren't gaming the system, if you will. But kind of the way we were looking at it was, let's take a married couple, for example. If your income is below taxable income is below $315,000, you get to take this 20% tax-free income cut for your business income. If your income is above $315,000, then the question to look at is whether your business is a service-based business or a non-service-based business.
So service-based business, examples of those would be attorneys, CPAs, doctors,
consulting businesses,
brokerage firms. So if you are a service-based business and your income is above the threshold, then your 20% tax-free tier starts to get phased out, and it phases out fairly quickly. So when you're roughly above 400,000, $415,000, you essentially don't get any benefit, right, if you are in the service business. Now, if you're in the non-service business, then the IRS has two other calculations to figure out whether you can use that 20% benefit or if you're capped. And they basically look at, how much wages you're paying to other people or to yourself, wages within your quote-unquote business, and also how much you own in depreciable assets at the entity level. So essentially, at the end of the day, what they're saying is, okay, if your income is high, over 400,000 roughly, then you may get to exclude 20% of income, but you have to make sure that, you have enough wages you're paying other people or you have enough assets that you're using for the particular business. One very interesting thing, though, because I think probably the most frequently asked question we've had over this last 4 to 6 weeks from clients has been, what is flow-through income? Do I need to go out and form an LLC? Or do I have to be a corporation or a partnership? And so I think one of the most interesting pieces that came out was that flow-through income when they defined it, they weren't really referencing flow-through entities. So at this point, it looks like the 20% deduction would apply to someone, again, LLC as corps partnerships, but also someone that's operating in their individual name as a sole proprietorship.
Exactly. Okay.
So
Wow.
if I'm flipping properties in Amanda Hahn's name, I would be eligible for this. And they also seem to reference that this applies to rental income as well. So if I just own a property on Main Street and after depreciation, everything, I still have taxable income, this looks to be one of the additional benefits that I could take as well. So the entity distinction is not really as important, let's say, as it is to try to stay under this $300,000-$400,000 income threshold to get the maximum benefit.
That would include trust, and then as far as how you held title.
Yeah, trust, and it depends on the trust too. A lot of what we see for our clients are like land trust and title holding trust or trust, and those are all considered flow through. In terms of this particular tax change.
So rental income we feel is part of this. What about trustee investment income?
Good question. So the types of income they've excluded specifically from this are interest income, maybe from trustee investments. So interest income, dividend income, and capital gains income currently are not eligible for this 20% tax-free exclusion.
But rentals are, okay.
But rentals, yeah. I mean, the way we read it, it appears that rentals would be, which was kind of shocking because I think our assumption was that that's part of investment income and would be excluded, but we'll see. I mean, I think, the way it's written now, and now it's, the IRS is going to go and actually put it in, tax link. Hopefully there won't be some changes there where they will exclude rental stuff, but that's the part we'll have to kind of wait and see when they work out all the final details about what's included and what's not.
What about estates? As far as estate tax, the size of the estate that's become not taxable, just tell me the changes. What is it currently, and what is it changing to?
Yeah, right now you're getting a top. Sorry, my earphones came out. The top state tax rate right now is 40%, and that's on estates above $5.6 million for a single person, 11.2 for a married couple. What they're changing that to is they're essentially doubling the amount before the rate kicks in. So the top rate of 40% is not changing, but now a single person can die with assets worth up to $11.2 million instead of $5.6 and not have to pay any estate tax.
Right.
And so 22.4.
When you say the top rate, it's like the only rate. So you don't have 15% for $2 million or something. You just have zero until you get to that rate. Is that correct?
Yeah. I think there is a slight graduated scale, but effectively most of it's at that high rate. But it's nice that they're saying that, obviously again, the ultra wealthy may still, people with estates worth $10 million or more may still have estate tax, but a lot of people, the estate tax issue may go away.
Yeah. The great majority.
Yeah, I think one of the benefits, when they were talking about the repeal of the estate tax or doubling it, one of the things that we were looking out for was whether the step-up basis would go away. So, in the past, if you bought a property for $1 million and when you passed away it was worth $5 million, then the $4 million of appreciation in your lifetime was essentially tax-free because when it gets to your beneficiaries, they inherit that at the $5 million mark. So they can sell it the next day, and their cost basis would be $5 million, creating zero gain. So one of the greatest things on the estate side of things for us is that not only have they doubled the exemption, but they also retained the step-up basis. So now essentially you can hold $11 million of assets per person, pass away with it, and have all of that be essentially tax-free gain when you leave it to your beneficiaries. So pretty powerful benefit that we were able to keep.
Yeah, not only keep, increase, huh?
Yeah.
One last question, and then I want you to think about anything that I didn't cover that you think I should have. If you're a California resident and you're paying whatever 12% or so in tax, and you're not deducting it now, and you start thinking about what that actually cost you to sit here, do you think that's going to have any ramifications for high tax states losing migration? You guys,
I don't know. I mean,
what's interesting is you have an audience of people every year, and I know one of the things that you get to see is the mood transition. Everything's going great or it stinks. But I just wondered if you've had any number of clients saying, it's just not worth it. I'll live half a year somewhere else.
Well, we definitely have that, and it's probably not to the great extent that maybe, at least from what we see, that people make it out to be. But we definitely have people that for sure leave California because they're tired of paying the 12-13%. They got the high tax rate.
Yeah, I think that, we do have a lot of, I would say that 50% of our clients, or maybe a little bit more than that now, are actually outside of California. So only part of our client base is actually, residents of California. But what's really interesting, you brought that up, is, just looking back maybe in the past 2 years, out of all the clients we work with, we only had 2 people who have moved into California from a different state. One of which was from Texas, the other one was from New York. So New York also has high taxes,
right.
And that they kind of moved in for a job change. But when I was speaking to our client from Texas, I was really shocked. I said, "Wow, I feel like you're moving the wrong direction," because the vast majority of our clients that are moving out to states like Texas and Florida and Georgia, where the tax rates are much lower. I don't know that the removal of state deductions would necessarily be the deciding factor. I think that if California were to increase rates even more, that might be a factor, and you might start to see more businesses moving out.
Right. What about any other topics that I didn't touch on?
Well, I think that, from a time perspective, it's, because we're in a unique situation, actually, where, as close as it is to the end of the year, we do have a couple days left, a couple business days, to try to take some action. So, I would just encourage anyone who have the time to look ahead. Some of the usual year-end strategies that we talk about in terms of accelerating expenses and deferring income, deferring capital gains and things like that, are still really great strategies. And in fact, they're probably more important than ever, especially since this is a year where, in a rare situation where we know that tax rates will be going down for a lot of people. By prepaying expenses and deferring income, not only do you defer the associated tax, but you also get a permanent tax savings just by playing with the difference in the tax rates, right? So getting a saving at today's 39% versus taking a deduction at, next year's 32%. So I think that's the main thing I want to, kind of encourage everyone to think about as we head into a Christmas season.
And, to piggyback on that a little bit, I think one of the other takeaways that I got from this is, we have a lot of people with, retirement planning is a big thing in terms of tax planning and wealth building and, self-directed retirement accounts, all that stuff. One of the things going forward is that they're changing is Roth IRA conversions. Now, you can still do Roth IRA conversions going forward. But let's say it's a 2017 example. Let's say you converted some money to a Roth sometime in 2017 or sometime before, the next week. Between now and whenever you file your 2017 return, you have the ability to look back on that transaction and say, hey, you know what? I want to undo that because my income was a lot higher than I thought it was going to be. So I'm going to end up paying more tax on that Roth conversion than I was planning to.
Okay.
So you have that ability to kind of, they call it re-characterize or undo the Roth conversion, as long as you do it before you file your 2017 return.
Okay.
But what's changing forward, if you do a conversion in 18, you no longer, or 18 or beyond, you no longer can quote unquote undo it after that. So if the takeaway, I think, is if anybody was really thinking about doing Roth conversions sometime in the next, 1 to 24 months, you may want to give some serious consideration to doing it in the next week, and then kind of hit the undo button later on before you file your 17 return if it doesn't make sense to keep it as is.
Any changes in the amounts you can set aside for all of these types of entities, SEP IRAs and all that, or is that unchanged for the new tax law?
Yeah, that's what they didn't touch that with respect to the new tax law. I think they, every year they increase it based on inflation and things like that, and they came out with those new numbers for 18. I want to say a few months ago, but those did not change with the new tax reform bill.
I forget the verbiage they used, but something about this expires in 2024 or something like that. What's the word they use?
Sunset.
Yeah.
So what does that mean?
Expiring.
It basically means that that whatever with respect to certain provisions of it, that it goes away after that year. Whether it's, I think a lot of them is actually 2025, so it sunsets after 2025. Where they pick that year versus 2023 or 2030, who the heck knows, right? But maybe that's when he feels like he's no longer going to be a president or something. But
it's interesting. Yeah, so sunset is sort of, the other word for it would be that it expires. So there are certain changes here in the, that we talked about today that are permanent changes that are never set to expire. So unless there's a new legislation to change it, for example, the corporate rates will be flat to 21%, forever and ever and ever, versus some of these other, the other exemptions or bonus depreciation or, these kinds of things will expire after a certain number of years. So that's really the only difference.
And all that's subject to renegotiation, of course, during the process. I mean, in the next 5 years, we could have a new president and we could have repeals or we could have changes that we have no idea are coming. None of this is locked in stone. Is that correct?
Yeah. So, it doesn't mean that we will forever have a corporate rate of 21%. Yeah, you're right. I mean, with the next election, different party controls the government, the odds are that could change. But yeah, so I think what's really interesting is that, I think regardless of what, you see on the news, I mean, I think that for the vast majority of Americans, they will see, some amount of tax savings starting in 2018.
Okay. All right. Anything, Aaron, that you can think of that I didn't mention?
No, I can't think so. I think we covered it a lot.
Okay.
And just so you guys know, this is just like a little interesting tidbit. Historically speaking, what happens is once the tax law passes, now IRS is going to actually draft up the language. They're going to get input from the AICPA and just different constituencies to tell them how that will work in reality. How to calculate these, what numbers are we considering. And then what we'll likely see is that there will be, some audits, right, on the IRS's side. That's going to go after, how people try to abuse the system, right, which is historically what happens. And then from there, we'll see some tax court cases, and then we'll get updates on, okay, what exactly do they mean by services business? Does this include XYZ things? So there's going to be plenty of changes and refinement, in the next 1 to 5 years, likely from, what the vote actually passed on yesterday. So the excitement will be around for quite some time.
Okay. Well, you guys, thank you so much for joining us. Do you mind giving your phone number out?
Yeah, sure. Our number is 1-877-975-0975.
All right. Well, you guys have a great Christmas season. And Matt and Amanda, thanks for joining us again.
Yeah, thanks again for having us.
Bye-bye.
All righty. Bye, guys. Bye-bye.
Bye, guys.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.